Hello everyone, welcome to KLI Market Commentary for September 22. My name is Avjit Puri and I am part of the team managing fixed income investments at Kotak Life. Today I plan to detail India's evolving external sector dynamics and the backdrop in which the Monetary Policy Committee will be announcing its resolution later this month. To begin with, we must understand that we are living in difficult times, where elevated inflation coexists with increasing recession risks and where synchronized policy actions coexist with an accelerating trend towards deglobalization. During such times, the Indian economy does offer a glimmer of hope. GDP is expected to expand by around 7% this year, the fastest amongst the major economies. But India is also not immune to macro risks, both domestic and global. As in the rest of the world, headline inflation in India has remained above the RBI's target band for the last 8 months and is expected to average 6.7% this year. The larger concern, however, is that inflationary pressures have become broad-based. Nearly 62% of CPI items have reported an inflation rate of above 5% in August, as against a number of 31% before the pandemic. Moving to the external sector, supply disruptions and geopolitical tensions are weighing on the trade deficit via higher energy and metal prices. India is a net commodity importer, and its oil imports constitute nearly 85% of overall oil requirements and 30% of its import bill. This has meant that trade deficit, which used to average around $12 to $15 billion every month before the pandemic, has now ballooned to around $25 billion on an average every month. This is putting pressure on the current account deficit, which is expected to widen to around 3.4% of GDP as against an average of 1.3% seen in the last 6 years leading into the pandemic. The current situation, however, is still far better compared to what we saw during taper tantrum in 2013, when emerging markets such as India were very badly impacted. As for the capital account, the global macro backdrop is not very favorable. Global central banks have embarked on an aggressive rate hike cycle in response to decadal high inflation, even if it comes at the compromise of some growth. To therefore finance such a large current account deficit will not be easy, as rising global interest rates will push capital away from emerging markets. In addition, global central banks are only now beginning to unwind the quantity of money available in the system. During the pandemic-affected years, the major central banks had expanded their balance sheets by around $10.5 trillion, while only $1.5 trillion has been unwound so far. The external sector metrics in India will therefore remain stretched, and BOP will register a deficit for the first time in 4 years. There could be some respite from debt market inflows if an announcement pertaining to India's inclusion in global bond indices is made soon. But for the time being, expectations of aggressive central bank tightening and higher trade deficit will continue to weigh on its external sector metrics. The INR has also been under pressure, but the extent of depreciation has been significantly less compared to other currencies. This is largely because the RBI has been defending the rupee, losing substantial forex reserves in the process. RBI's intervention has been to the tune of almost $100 billion across spot and forward markets. India, however, still has a war chest of FX reserves, so there is no reason to panic just yet. FX reserves can still meet import requirements of almost 9 months and are almost 1.5 times the gross financing requirements of the economy over the next 12 months. So in response to above target inflation and external sector vulnerabilities, the RBI has been proactively front-loading its policy actions. It has so far raised the policy repo rate by 140 basis to 5.40%. The RBI has also been normalizing the quantum of liquidity available in the banking system. Durable liquidity, which was at 11 trillion rupees at the peak of the pandemic, has now come down to around 4 trillion rupees currently. So heading into the September meeting, the Monetary Policy Committee remains mindful of the external sector vulnerabilities. The committee also understands that its job remains cut out as global central banks lift policy rates above the neutral level in order to engineer a growth slowdown. Given that CPI inflation still remains well above the RBI's target band, we expect the MPC to continue to front-load its policy actions and deliver another repo rate hike of 35 to 50 basis. For the external sector, MPC's actions will aim at minimizing the INR volatility stemming from the narrowing interest rate differentials. In such a volatile environment, pinpointing the terminal rate in this cycle is particularly difficult, given the persistence of elevated inflation, geopolitical tensions, and uncertainty about the pass-through of previous policy changes. But if the global macro backdrop were to turn more unfavorable, a terminal rate in excess of 6% cannot be ruled out. Thank you.